There were a lot of questions about what he might say on Friday and whether or not that would land him in hot water. From what I saw,
illegal conduct. They'll look at his internal, his communications with other
potential stock
people,
manipulation around
without attracting regulatory scrutiny.
At the end of this video, you will understand how Keith Gill turned $54,000 into $1 billion.
It is true that my investment in that company multiplied in value many times.
I will also show you how you can make the same trades. In January 2021, Keith went from a simple ordinary trader to a millionaire and the unlikely hero of a stock trading revolution. You may have heard the exciting story of how Keith ignited a movement where everyday ordinary traders rallied against the institutional overlords to save their favorite gaming store. But there's so much more to this story than the media initially portrayed. So I'm going to break down everything you need to know in simple terms and tell the real story. But also, Keith now being accused of market manipulation.
From Gill, who also goes by Roaring Kitty, amounts to any sort of market manipulation. Gill, of course, is the person who led a band of retail traders into the GameStop short
So
squeeze.
what does the future hold for Keith and the movement he started in 2021? The stock market was simply out of reach for a lot of people. It was assumed that you needed a lot of money and a formal education to buy and sell shares. However, the internet has simply broken down all of these barriers, and you can now trade stocks and learn about different companies, all from the phone in your pocket. Keith was one of these everyday ordinary people, buying and selling stocks that was not completely new to trading either. He was working as a stock analyst for a number of startups and tech companies. And although he did not make a huge amount of money, he did pick up the tools needed to achieve long-term results in the stock market. My salary never exceeded $40,000. But I did learn something about investing. I learned how to do the tedious work of digging through a company's financials and focusing on its real long-term value. So he decided to share his wisdom with other people online. He set up a Twitter account named The Roaring Kitty and a Reddit account called Deep Effing Value, where he regularly posted on a Reddit forum named Wall Street Bets. Another barrier for people getting into stock trading is the complicated language and the terminology people in the business world use. With Keith, we have someone who's able to speak about investing in very simple and uncomplicated terms. And of course, he used a lot of memes to get his points across too. In 2019, he realized something strange about the company GameStop, a retail store that allows you to buy and sell video games. It was this company that would unknowingly make Keith a revolutionary and a millionaire at the same time. The investment market had completely written off GameStop, and from their perspective, GameStop was not compatible with the modern gaming consumers. People were no longer going into a physical store to buy games. Instead, they purchased them online. In fact, people could now download them directly from their console. As you can see in this graph, the share price from 2015 to 2019 is only going in one direction. For these reasons, many people thought that GameStop was a sinking ship, but Keith firmly disagreed. Like any other company he invested in, he did the grind work of looking through all of their accounts and metrics and came to this own conclusion. He believed that GameStop was seriously undervalued. A big sign of this was in June 2019, when Michael Burry purchased roughly 3% of its shares, and he too felt the stock was undervalued. However, although Burry was investing in GameStop's future, many shareholders were investing in GameStop's demise, and this is known as short selling. Let's just give you a very basic explanation of short selling, and since we're talking about gaming, let's give this basic analogy here. Let's just say your friend owns a brand new PlayStation and you ask to borrow it, so long as you promise to give it back in 6 months. However, instead of playing the PlayStation, you immediately sell it to somebody for $300. And that is because you've predicted that the price of PlayStation is going to drop significantly in 6 months. Maybe you've done some research and you know that a new PlayStation is coming out in 3 months. So 6 months later, before your friend comes calling for his PlayStation back, you go into the store and you buy a PlayStation, which is now priced at $250. Your friend gets what he thinks is his brand new PlayStation back and is none the wiser, but you've sold it for $300 and you only paid $250 for it back. So by short selling, you've made $50. This was what people were doing with shares in GameStop, buying their shares with the assumption that they were going to go down in the near future. In fact, a staggering 63% of its shares were owned by people short selling the stock. And if the majority of your shareholders are people betting on you to fail, this is bad news. GameStop's response was to buy back some of the shares and take them off the stock exchange, which did two things. One, there was a smaller percentage of shareholders shorting the stock. And secondly, the smaller volume of shares in the market could possibly drive the price up. By August 2019, GameStop's share price went down to $3.97 per share. So GameStop repurchased 34% of its shares and made them unavailable to the public. While GameStop was seemingly in turmoil, Keith had purchased $53,000 worth of GameStop shares. So why did he make such an seemingly unwise investment? What did he see others investors didn't? In one of his streams, Keith explains that the investment world looks at GameStop as a cigar butt, whereas he sees GameStop as a roach. A cigar butt is something that was previously useful, but its use has come to a complete end. A physical video game store on a local high street was useful 10 years ago, but today most people don't need it. And like a used cigar butt, it is time to throw it away. Keith, meanwhile, saw GameStop like a roach. This is the end of a smoking apparatus. I probably can't say any more than that on YouTube, but this can be reused over and over again, right? You get the idea. From his perspective, most of the people short selling GameStop overlooked a niche that the company has. The reason why shopping malls still exist and we don't simply buy everything online is that the consumer still values the shopping experience. GameStop has a sense of community in its stores and people have nostalgia for buying some of their favorite games there. This is a value that doesn't necessarily pop up on the share price and balance sheets and is only something that a regular customer would understand. But ultimately, things were not looking great for GameStop. And the following year, the pandemic hit and GameStop had to shut all of its stores. It was a complete catastrophe. But even in the middle of the pandemic, when all hope was lost, GameStop found a glimmer of hope. In August 2020, Ryan Cohen, the CEO of the pet brand Chewy, started investing in GameStop. He had basically looked at their accounts and came to the same conclusion as Keith. The company was highly undervalued. Cohen told news outlets, "I invested in GameStop because I thought it was cheap and the intrinsic value of the business was worth more than the price that I paid." There's a tremendous amount of skepticism around GameStop, and those are the things that I like. Looking at things while no one is looking at them. So not one, but two highly successful investors thought that GameStop shares were undervalued. And by the end of November, the GameStop share price reached $16.56. Given that the price was only $6 or $7 in 2019, Michael Burry saw this as a good time to sell his shares. As you see a bit later, this is probably a decision he'd regret for the rest of his life. Since Ryan Cohen owned 10% of the shares, he joined the board of directors on the 11th of January. He also brought with him Alan Attal and Jim Gruber, both of whom were e-commerce specialists at Chewy. Cohen also increased his share stake to 13%. As you can imagine, this gave the market confidence in GameStop and its price continued to go up. This stock price jumped further up to $38.65. Barry was probably cursing his luck for not selling at this price instead, but things were about to get even crazier. Despite the optimism surrounding GameStop, there were people still going short. Melvin Capital was one of the major investment firms predicting GameStop's demise. But the one that made the news was Citron Research, who publicly announced that they were going short. And for many people, going public on a short-selling investment was a big problem. Because a big investor like Citron was going short, this was an indicator for the market that the share price was going down. So by making this public, it was alleged that Citron was manipulating the market. In response, Keith launched a movement. He wanted people to continue to invest in GameStop, and he explained his research. Feeling the heat from Keith, Citron Research tweeted, "Tomorrow AM, 11:30 Eastern Time, Citron will live stream the 5 reasons GameStop buyers at these levels are the suckers at this poker game. Stock back to 20 fast. We understand short interest better than you and will explain." However, Citron Research held back on releasing this report. They felt that they were being harassed online and held back for now. As a major short-selling company, they were seen as the bad guys because they were perceived as trying to make money off somebody else's failure. And a few days later, Citron would deeply regret ever sending out that tweet. GameStop, by this stage, was an incredibly confusing situation. It was revealed that the number of GameStop shares that had been shorted had reached 140%. What happened was that the shorted shares had been re-rented to the extent that there were more shorted shares than shares that were actually available. Given this figure, it would seem incredibly unwise to invest in GameStop. However, this is where Keith started to properly rally the troops and get people investing in GameStop. And retail traders started buying GameStop shares in their droves. So why would anyone buy shares at this stage? Well, people were told online that the stock was going up and wanted to make money. They also wanted to save GameStop, the company, and their beloved gaming store, which they saw was being taken down by ruthless investors. And lastly, but definitely not least, Keith was also portrayed as the little guy going up against the system. So many people joined this journey by buying GameStop stock. And while institutional investors expected the share price to go down, the opposite happened. And shares actually went up by over 50% to $65.01. For the first time ever, it seemed like the share price was not being driven by Wall Street, but by everyday traders. On January 27th, the number of people trading GameStop shares each day shot up to nearly 900,000, which is the equivalent of the entire population of San Francisco. And shares rose up by 2,700% from January 8th to 28th. And as you can see from this chart, this period between January 25th and February 2nd is where it just ballooned beyond any expected levels. And remember, short sellers were expecting the stock to go down, so for them this was the worst possible news ever. To make sense of this, let's go back to the analogy of you selling your friend's PlayStation. So you've expected the price of a PlayStation to go down, but what happens if it goes up? What happens if it goes up by $500 or by $5,000? This is where you can see the real risk in short selling. If you invest $100 in stocks in the normal way, the worst case scenario is that you will lose all of your money. If you're short selling, the loss you can make is infinite. By January 27th, GameStop shares were at $380 per share. Citron Capital and Melvin were basically now forced to admit defeat and take a devastating loss. This turned out to be a wise move, as it reached $500 the next day. Keith had made arguably one of the most successful trades ever seen. His $53,000 trade rose up to 48 million in January 2021. Retail investors seemed to be winning the battle until their time in the sun came to a grinding halt. And this is when the conspiracy theories began to emerge. The Robinhood app, where most retail investors had bought GameStop shares, decided to do something quite controversial. Suddenly, their users were no longer able to purchase GameStop shares, but were still allowed to sell them. This fueled a conspiracy theory that the owners of Robinhood were close friends with hedge fund managers, particularly Citadel, who paid Robinhood a fee for order flow. This adds up to half of Robinhood's revenue. So when Robinhood closed the door shut on retail investors to stop them from buying GameStop, well, it looked rather fishy. On February 4th, Robinhood lifted the trading restrictions on GameStop, bringing the price down to $53.50. However, there was another twist in the tale. The SEC released a report which discovered that the David versus Goliath dynamic that was suggested to be at play was not necessarily the reality. The SEC found that this rise in GameStop shares wasn't necessarily a win for the little guy. Investors on Wall Street had also jumped on the GameStop bandwagon themselves and made enormous amounts of money too. Richard Marshall, an investor at the New York-based Senvest Management, made $700 million from GameStop. So it's not just the retail investors driving up the price of GameStop shares, but also major investment funds. On the other side of the coin, there were also everyday retail investors who bought GameStop shares too late and lost a lot of money. GameStop shares were dubbed meme stocks because it was stock rising as part of an internet fad, and like all fads, it started to lose its momentum. This is why I would strongly discourage this type of investment, as it's incredibly unpredictable. As for the short sellers, they had invested in GameStop, but this only consisted of a fraction of the overall buying value. These funds did not have as much power as everybody initially thought. But what about the Robinhood app? Why did they suddenly stop retail investors from buying GameStop shares? Well, the SEC report explains that they had not succumbed to the hedge fund overlords, but merely did not have the capacity to take on any more trades. Do I believe that? Well, if they could take on sell trades, but not buy trades, then the story makes very little sense. It was also in the aftermath that authorities started looking into Keith. Keith was a securities analyst and should not have been advising people to buy stocks online. Had his employer known that he was advising people about buying stocks online, he would have probably been told to stop or even been fired. Now, having been called to testify before Congress, Keith simply said that his social media posts on GameStop had been for educational purposes only. But in the aftermath, Keith basically disappeared. And as you can see from this graph, a lot of the hype surrounding GameStop started to go down in 2022. However, on May 13th this year, Gill posted on Twitter this image of someone getting off a chair. And after 3 years, Keith was finally back.
Oh, am I okay? I'm alive. Kinda.
Welcome, everybody.
On June 2nd, Keith's account posted positions in GameStop showing 5 million shares purchased for $21.24 for a total of almost $116 million. As most people suspected, Gill had become a multi-millionaire. Keith Gill also has 120,000 of what's known as call options. These are a different type of stock trading instrument. So let me give you a very quick and simple explanation of what these are. Let's just say your local pizza joint is giving away pizza coupons. For $10, you can purchase a coupon that'll get you a large pepperoni pizza. And let's say that in the meantime, the price of pepperoni skyrockets and this pizza now costs $20 at the same pizza joint. Well, with this coupon, you can still get a large pepperoni pizza for the $10 that you originally paid for. Now, like many coupons, there is an expiry date. You're going to need to have this pizza by a certain time period. But let's say the opposite happened. Let's say that the price of pepperoni plummets and your pizza joint decides to sell pizzas for only $5. Does this not mean that you've lost $5? Well, not really. But these things are called options because the buyer has the option to buy the stock, but they don't have to buy them. So if this had happened at the pizza place, imagine you also had the option to come back with your receipt of $10 for the coupon and they give you a full refund. This is what Keith has done with 120,000 shares. And it's assumed that GameStop shares are going to continue to go up in the near future. On June 7th, Keith jumped back on the live stream, and despite the fact that it was 3 years later, he basically did not say anything new and simply reiterated his message that Ryan Cohen is the man to steer the ship for GameStop. Well, with these two charts here, you can see that Keith's reemergence caused the price of the stock to skyrocket again. But it fizzled back down when he didn't have anything major or new to say. Plus, GameStop has been using these rallies to issue a load of shares themselves to collect a lot of cash to pay off their debt. So the supply of shares kept increasing. Now, Keith is arguably doing the same thing that he complained about all those years ago. He has used a sizable online platform to boost the share price of a company that he owns a lot of shares in. Many people came to the conclusion that this was maybe market manipulation. But the slight irony didn't pass Keith's former friends at Citron Research, and they were basically saying what made Keith Gill, aka Kitty, interesting initially was his authenticity. He shared a detailed investment thesis and put his money where his mouth was, which combined with a high short interest and a restless country in boom, well, the rest is investing history. This time it feels different. Now with GameStop, he posts with a large account in a significant near-term options position, appearing more like manipulation without a solid thesis. Considering the stock is now 2,000% higher than its initially video almost 4 years ago, we believe someone is backing Gill. There's no way he made this size of trade alone. His reported finances do not support this trade. Possibly a bitter hedge fund manager saying that. Now, Keith's next move will be interesting to see. The regulators are looking into him, whether the recent activity could be considered market manipulation. And that could be another twist in this rather fascinating tale. But let me know what you think of Keith. Hero or hero turned villain? I like that he opened up regular people to trading, but I personally don't think meme stocks are the way forward for most people. But let me know your thoughts in the comment sections down below. If you enjoyed this video, share it with a friend who might get something out of it. I thank you for watching, and I hope to see you on the next one.